Hello and welcome from me, Philip Nothard, and Curtis Hutchinson to this special Motor Trade Radio podcast brought to you in association with eBay Motors Group. Many thanks again for joining us in this 22nd in our series of special interviews themed around sharing best practices during these challenging times across the sector. Previous interviews with Sytner CEO Darren Edwards, Suzuki boss Dio White, Mitsubishi MD Rob Linley, and last week's chat with Louise Wallace from the NFDA, and many more are still available to stream online from Apple and Google Podcasts, Spotify, SoundCloud and Deezer.
Now, today we're delighted to welcome back to the podcast Mike Allen, Head of Research at Zeus Capital, the investment bank, where he closely monitors the PLC dealer groups. So welcome back to the podcast, Mike.
Hi, guys. Good to be back on. It's been a while, so looking forward to it.
Yeah, no, it's great to have you back, and it's also very timely because we've now got dealers out of lockdown. The 70 plate is on sale, and September appears to be shaping up to be a strong month. Now, we've also had the first wave of interims and trading statements from the listed groups, which have begun to shed some light on the impact that the lockdown had on bottom lines and also future trading forecasts. So plenty to talk about.
Yeah. Welcome back, Mike. There's a lot to talk about. It's been a busy time, hasn't it, for many. So I think let's start with some of those updates from the PLCs that were sort of, some of them were delayed, but obviously we as we've come out of lockdown now, they've started to sort of publish them. So starting with Cambria, which highlighted a strong bounce back from June to August, but a slow order take going into September. And obviously they were talking about their concerns over the fourth quarter of the year. But what stood out for yourself with that announcement, Mike?
Yeah, so I mean, Cambria is an interesting one. Don't forget there's different year ends at play here. So Cambria's got a August year end, and clearly they already indicated to the market that they'd had a good first half of the year, which wasn't really impacted by COVID. It appears that they definitely managed cash very well during lockdown, and they've seen a similar bounce back from June, July, probably going into August. However, as you say, the order intake comments that they made about September, has been more cautious relative to others in the sector. I think one thing I probably would say about Cambria, though, is naturally, even before COVID-19, their outlook had typically been a bit more conservative around Brexit and supply constraints and changing powertrain, etc. So they typically are fairly conservative in their guidance and, typically prepare for the worst, really. But, we expect with a half one already kind of, in the bag, we believe the 20 results will be, within 20% of last year anyway. And we think they've been pretty strong on cost initiatives in the business. So I think with all of them, we'll see how September goes. It's clear that there definitely is still pent-up demand. And, perhaps with some brands, hopefully the supply is there to support it.
And I think just on that, you mentioned the brands there, and we obviously had Mark Lavery on the podcast. I think was it pre-lockdown? I think it was, actually. It's that long ago. But it was.
Can you remember back that far?
Yeah, it seems a long time ago now. But obviously, Mark went through some of his brand portfolio, didn't he? And how long some of the brands do take to develop within the business and things like that. So do you think some of that has a lot to do with sort of brand Cambria's different view of the market? Because they do have a fairly diverse brand portfolio, don't they?
It could be that, and it could also be the maturity of some of the sites, because they were fairly acquisitive over the last 12, 18 months. And also, I think it does take time to develop all the banks with high luxury brands. So that could be a factor. But obviously, I think we'll learn a bit more towards the end of November when they report their results.
Yeah, now, as you say, Mike, Cambria were possibly more hawkish than some of the other groups in their commentary about September. And I guess on the flip side, there's been more positive messaging, despite losses coming out of Marshall and Virtue. So what do you make of their most recent updates?
Yeah, I mean, they've definitely been a little bit more upbeat around September. I think, we've seen similar kind of patterns in terms of the bounce back from June. I mean, I guess I'd probably explain this in three phases. The first phase, when we realised, dealerships had to close and couldn't actually trade except for after sales for essential services, I started looking at the operating expenses of some of these businesses and what could the potential cash burn be. And that's pretty scary when you look at the level of fixed costs in these businesses. Now, clearly, the furlough scheme, I think, has helped everybody, and staff costs are typically around 60% of costs. So that's been very useful, to say the least. But I think during lockdown, I'd say every PLC company had kind of managed their kind of cash resources very well. Obviously, there was a lack of fleet activity that helped working capital, but it was clear when we saw the losses during April and May, they were a lot less than what I first feared. So I think that's testament to kind of, obviously the furlough scheme, but obviously strong operational discipline. And then I think coming out of lockdown, in our last couple of research notes for Virtue and Marshall, we've shown the impact of April and May, and, pretty much they probably covered 70-80% plus of losses incurred during April and May. They've recouped that back from June and July from the pent-up demand. And I think both companies have probably been quite proactive in terms of bringing people back quickly from furlough. I know Virtue have invested in marketing, etc. So I think they've done everything they can to make the most of that kind of bounce back in June and July. And ordinarily, we'd expect August to be a loss-making month for most of the retailers, and it feels anecdotally that actually they've made kind of small profits. So, perhaps going into September, a lot of the losses incurred during April and May have kind of been recouped. Which is great news.
And not specifically Marshall and Virtue, but what are you hearing from the groups that you're talking about regarding that pent-up demand for September? Is that a sort of common theme in conversations you're having?
Yeah, I think the pent-up demand we've seen since June definitely took me by surprise. I didn't expect to see some of the kind of monthly profit numbers that Virtue and Marshalls have kind of made, and that's been backed up with other conversations I've had with private dealers across the industry as well. So I think it's been a kind of consistent theme, which is good news. The problem with pent-up demand is obviously, there's just no visibility on how long that lasts, and hopefully we'll see that continue into September, which is a key month, which feels like anecdotally it should do. I hope the supply is there to kind of support it, as I've said, but it's so far so good. I think there is nervousness around the wider UK economy in Q4, and what happens when furlough ends. Do we get mass levels of unemployment or not? We've got to throw Brexit into the mix of that as well. So, so I think we are bracing ourselves for a very uncertain kind of Q4 and into 21.
Yeah, no, I think it's obviously been tagged as sort of pent up demand or revenge buying has been sort of muted a few times as well, hasn't it? But obviously, I mean, just before moving on slightly, but Marshalls in the recent days have announced their sort of appointment of two key colleagues to two key positions, haven't they? With Adrian Wallington joining as a commercial development director, Simon Elliott as director of commercial vehicles, and then you've got Caroline Eiling, who's joined as the HR employment lawyer, and then Matt Wilmot, who's head of group legal. So, I mean, how's is that a key move for someone like Marshalls as they look to grow their strategy and that getting those appointments on board?
I mean, I think Marshall's obviously got a very, reliable, solid platform, we think, in the industry, and they've got a strong balance sheet. So, they're probably looking ahead at the long term at how to kind of grow the business. And, it's been well documented, and I think we all agree that capacity will kind of come out of the industry, and the prize for the well-run, bigger PLC kind of dealer groups that can cope with increasing regulation, have got strong values, well-motivated management teams. I think the prize is probably bigger for those companies. So, I suspect Dash is thinking a little bit longer term, and, as ever, will want to improve the platform that he's got so he can take benefit of the prize at the end of this. And he probably sees the opportunity, which is a smart move.
And along that, I mean, last weekend with the last podcast, Curtis and I talked about obviously the what's been coming out of the Pendragon recently with the ditching of the car store brands and its move to replace with a more digitally led used supermarket operation. And their growth plans, I think it's by 2024, is it, or 2025? They've got some significant growth plans. And that's kind of along that same line, that there is opportunities and thinking ahead of what the market may offer them. But what are your thoughts around that and the direction that the group is now going in?
Well, I think the document and the thinking was very, very well put together. And, I mean, simply the kind of, anything where they don't have kind of scale or focus, they want to get, they will exit. And equally, they see a large opportunity in kind of used cars, interestingly, running that kind of business separately from the kind of franchise model. And obviously, I think Bill Berman's got a great experience in the US market. I'm sure he's got a lot of ideas in the, how to apply that in the UK market as well. And I think, as we've seen from Kazoo, even, I think people are on different lines of the spectrum in terms of digital and physical presence, but it's pretty clear that you need clicks and bricks really to have an impact in the used car market. And I think everybody acknowledges that. It's just what degree you move towards digital versus physical presence. So I think the Pendragon plan, I think, is looks really good. They've put numbers and targets around it as well, which is great to see. There's a lot of detail behind that plan, and I think they can get there. Even with a kind of envisaged difficult market in 2020 and maybe see a recovery in 22, 23. I think they can get there, but obviously it's all very well having a kind of great plan and sensible plan, which it certainly is, but execution is always going to be more difficult. So I think Pendragon are on the right lines now, and hopefully they can execute, because it'd be great to see them kind of back in the market as a kind of, as a kind of force, and hopefully, I think the industry has been increasing its standards over the last few years, but obviously it's faced kind of many challenges. But I think we'll look back on this for all the businesses and what they've had to cope with during lockdown, and say, they did a very good job coming out of this.
Now, Mike, also restructuring and rebooting, albeit for different reasons, is Lookers. Now, we're still awaiting Lookers' delayed year ends, and it's obviously still undergoing an accounting investigation. Where do you see the group going from here?
Yeah, I mean, obviously, there's been a lot of challenges for Mark Rayban, and which he's walked into really. So monumental challenges really. I think the business has to move on really, and I think in the last trading update from Lookers, let's not forget they've also participated in this market recovery as well. So I think we've got to kind of get the bad news out of the way and then kind of move on. But I think it's clearly they've had challenges, but equally, this has been a very good business in the past, and it probably has lost its way in the last couple of years. But I still firmly believe there's a kind of strong core there, and perhaps with better integration of previous acquisitions, it could be a force in the future. It'll take time, but I think there is a good core to that business in my view.
I mean, in terms of that, and you kind of touched on some of it there, but what is the city's view on the sector in terms of its ability to deal with trading in the current pandemic and obviously attract investment? I think the Pendragon, I think the shares reacted fairly positive to their announcement of their strategic plans. We know that Lookers are still currently suspended in terms of share price, but we've gone through this, and it's fairly public that the government haven't really focused on the automotive sector uniquely in any way, have they, with any key support. There was the talk of scrappage and things like this, but actually we've come out the other end. I think you highlighted it earlier. I think the recovery has seen a quicker pent up than many did expect. Just bear me a second. Interruption there. So it's sorry, no, it is live. I do apologise.
Yeah, time to wake up, Phil.
Yes, that's it. Alarms are going. But I think what is the city's view on the sector at the minute? What is it? I mean, we've seen the continuing investment, we've seen potential growth coming. What is the view at the minute?
I think the city loves a good recovery story, and I think a lot of investors are kind of waiting to see and the right time. And we've seen kind of the sector in cyclical distress before, in 2008, but the kind of bounce back in share prices was quite severe, on the upside. So investors aren't going to want to miss that. But equally, there has been some bad news from high-profile players. I think people might want to see what's been behind the kind of the look story. Hopefully it can get a clean bill of health moving forward, and maybe there's a bit more confidence going forward. But having said that, I think again the Virtue share price kind of bounced back quite strongly as well on the back of just being able to show investors really what the impact of lockdown was, how sharp the recovery's been, and we can always kind of map out now what we think the full year numbers might be, obviously with a bit of uncertainty. I think investors realise that recovery can be quite sharp and quick here. As ever, they'll want to play it. Timing is everything really in investment, and they'll want to see that most of the kind of the bad news is kind of out of the way. But I think the more the likes of the Virtues, the Marshalls, even the Cambrias, can show that they've coped with these kind of headwinds, then I think that they will get some good support. Equally, again, hate to mention Brexit, but it is such an important dynamic, really, both from a supply and demand side, in the sector. The sector is pretty UK. It is very UK centric. So again, I think we'll have to assess what the impact of Brexit and what it could have. But I think there's no doubt that even without kind of full forecasts in the market, we've seen bounce backs in share prices because there's a lot of kind of freehold asset support at the moment, and hopefully as we bring forecasts back and just show that severity of the positive bounce back, then I think it will give more people more confidence in the months to come.
Now, Mike, Phil and I have known you for a long time, and whenever we chat, talk inevitably moves on to consolidation and what the trends are. And for as long as I can remember, that trend has been rising. However, after the COVID lockdown, the dealer world looks quite different, with more privately owned groups considering their future and possible exit strategies. So do you see this current situation as being a prompt for accelerated consolidation?
I think we will see more consolidation, but I think people will be waiting for capacity to come out of the market as well. So I wouldn't assume all of the kind of distressed assets will be consolidated. So I think we'll see natural attrition come out of the industry, and then we may well see kind of consolidation at the distressed end of the market, where there's potentially a long-term future with a better parent company. And we have kind of talked about kind of super groups before, and could that happen? And I don't think you can rule that out really, particularly if if you look at some of the brand networks, there's an element of the requirements from the OEMs for investment, etc. Does that require more super groups? So I think we'll see a couple of interesting consolidation angles at either end of the market.
Because the likes of, and we've talked about them, Virtue and Marshalls, they've been quite vocal about their thoughts on acquisitions, and clearly they are looking.
Yeah, I mean, I think they've got a great platform, both companies. They've got strong balance sheets. They've both got leaders with very clear values. They know exactly what they want. And why wouldn't you want to increase and grow the platforms that they've got? Because they've built those businesses themselves, really, and they're going to see a lot of opportunities. So to me, it makes perfect sense expanding what's already a very solid and reliable platform in both cases.
And I mean, we couldn't have you on the show without asking your views on agency model, which was prompted in discussion recently from Marshall Motors CEO Dash Gupta, and he was obviously talking of how much he likes that as a proposition, and how well it works for some of the brands he represents. And then obviously, last week we had Louise Wallace on from the NFDA and outlined last week on some of the show that it was an old model with benefits for both sides, the retail and the OEM. But do you see it coming back into vogue, especially in a recession? And as we move towards an uncertain Brexit, as we've just mentioned before, but could you see this move accelerating?
Well, I mean, I think what I'd say is Dash is clearly a lot closer to the OEMs than I am, and obviously, I think the agency model, it's easy to kind of generalize about agency models and say, well, is it a loss of control? There's clear that, there is clear kind of working capital benefits of that model. But I think, it wouldn't surprise me to see certain brands, want to adopt the kind of agency model. But it'll be done on a kind of brand by brand basis. I mean, and obviously, for me as an analyst, I'd kind of want to see a lot more of the kind of finer detail on what it entails. You know, obviously, as we said, there's clear cash flow benefits, but you know, if there is a kind of reduction in margin, you know, how much is that? I can see, you know, if the whole industry was to kind of go agency, you know, there might be kind of comments on kind of valuation. You know, what would the margins? What do the margins look like? Are they going to be down even more? And there is sometimes a little bit of sensitivity around the low margin nature of the industry. But what people fail to understand is the margin is part of the structure of the industry, and you can generate good returns on capital off those margins at the right time. So, and what does it mean for kind of competition? You know, is there less competition? Do you have bigger territory areas? What are the barriers to entry? You know, particularly with, you know, more kind of online kind of startups looking, you know, is that protected for the dealer? So there's an awful lot of questions. But I think in short, it wouldn't surprise me to see a little bit more kind of agency model activity. But I think it'll be on a kind of brand basis, and obviously it's in the OEM's you know, interest for the network to be diversified and for it to kind of survive. So, you know, financially it would have to work for the dealers. So I realise it's probably quite a long answer, but it is understanding the detail on a kind of brand and network basis, I think, before you'd kind of go back and say it's a good or a bad thing. You know, it's got to work for the dealers and the OEMs, and you know, it's an interesting development, which we'll see how that goes.
Yeah, I don't think we've heard the last of this, and I'm sure it's something we'll be revisiting on a regular basis. Over
a lot of variables, isn't there? There is a lot of variables. Yeah. That's it. I mean, like you say, that impact of margin, and you know, that relationship with the customer, who owns the customer to a certain extent in terms of that data. There's a lot to talk about, and as you say, you know, there's some manufacturers will have appetite to do it, and some manufacturers won't have any appetite to do it at all, because at the end of the day, it's that ownership of the stock and the vehicle and things like this that some will be quite happy for the dealer to take the responsibility and cash flow on rather than them.
I mean, the other advantage, I guess, could just be it would allow the dealers to put more focus into used cars and after sales, where they make more money anyway. So it's quite complex.
So finally, Mike, any thoughts on how the sector will fare as we sort of go into Q4 and, more importantly, 2021? Just how bumpy a ride do you think this is going to be?
It's never a smooth ride, is it, in this sector?
No. Keeps us all busy, though, Mike. Keeps us busy.
It keeps us all busy. You know, I think the main thing I'm looking for in Q4 is probably the employment market and how big does how great are the kind of unemployment numbers, and I think that might have a kind of a knock-on effect, and it'll give you an idea of potentially the market in 2021. I think the kind of easy part of the recovery has kind of happened now. So I think GDP is back above 70% of pre-COVID kind of levels. And that extra 30% to get it back to where it was is going to be slower and harder, I think. We then obviously got to kind of throw Brexit into the mix as well. And I think we'll be looking at, you know, how does sterling perform through that, because I think that will have a big impact on supply. So, you know, I think during the fourth quarter we'll be keeping a very close eye on sterling and employment levels and general kind of business confidence, really. But, equally, I think we'll look back at 2020, for the dealers to have to close in the most important week of the trading year, and for them to have kind of, clawed back a lot of those kind of losses of being shut down. It's not even you're trading through a recession and everything's open. It's, you're shut for 2 months. I think when we look back at those kind of challenges, because I think most people have just kind of got on with it, I think it will give you a bit of confidence for everyone is going to throw challenges up. There is going to be a lot of uncertainty. But look what's been achieved in a kind of quite a traumatic year, really. And, for kind of marshals to be, virtue, potentially making an okay profit. I think we'll look back and say, actually, these businesses are more resilient than what they've been given credit for. For the balance sheet damage of being shut for a couple of months, potentially being not nearly as bad as expected. Again, I think that kind of should give us confidence going into 21, but I need to expect kind of further challenges. And as you say, UK economy, I think next year is, I think the easy bit of the recovery is being done. I think going into next year, it's any further recovery is going to be hard won, and let's see what Brexit brings as well. So it's never going to be easy.
No, I mean, thanks, Mike, for all that. Just for me, I think, there's a lot of talk on Q4. A lot of the challenges there, as you say, at the end of furlough there. But I think, we said it before that I think the market recovered quicker than many probably anticipated. I think the sector has truly shown its resilience and ability to, get back up and running and get business done. And I think, from a used wholesale perspective, that's still a strong market at the minute, as we've been talking about, and the values are still holding strong. There is a supply and demand imbalance potentially at the minute, but again, a lot of that will be focused on Q4, and then, as you say, Brexit is the key one now around what the impact will be as we go into 2021 in terms of supply and tariff impacts and things like this. So, it's going to be an interesting time. And, as you said before, with the latest from Pendragon, the growth indicated from both Marshalls and Virtue, most recently, is is it a smaller market that these guys are going to be going after? That's some of the key with this. If the new car market does drop and has a direct impact on used supply, then the market is a smaller pot to go for, with some bigger operators. So there's so many variables that could hit us.
Yeah, absolutely.
Well, many thanks for joining us today, Mike. Great to have you on the show, and you're welcome back anytime. That's
always
all.
A pleasure.
Yeah, no, it's great to have you on. Many thanks. That's all for now. You've been listening to this special Motor Trade Radio podcast brought to you in association with eBay Motors Group. Please like and share on social media, as it's important during these times for the dealer community to work together and share experiences and best practices. Many thanks to you for listening and supporting the podcast. Philip and I will be back with the industry headlines on Saturday. Until then, stay safe and stay well.